So welcome, Mark Cannella, University of Vermont Extension. I'm a farm business specialist. I've been working with maple producers on business and finances for the past several years as well. Tonight's presentation will be on maple financial planning. What I hope to do is bring you through a few different projects and a few different approaches that we've taken to financial analysis with maple producers, a little bit of financial research on maple startups, and our benchmarking program, which has been going now since 2014 is the first year we started benchmarking maple producers, and that's detailed financial analyses with active businesses. So I'm going to jump right in. This one's rescheduled, so we're here on the 28th. We've got one more webinar coming up next week, which is SAP Business Models with Chris Lindgren. That'll be our last webinar of the fall season. Financial goals. So let's dive right into it. I guess one of the things that I'll say for people watching tonight or watching the recording, I guess the big question is, who's going to benefit from this information, or who wants to know this information? I know that I have been meeting on occasion with agricultural lenders. They're really interested to know the financial performance of businesses. They're also becoming increasingly interested in the startup investment for businesses, especially as they look to deploy capital for big startups, big setups of sugar bushes. So getting a sense of those investment levels has been key from the lending community. I think we're also aware that there's a number of maple producers that are out there, perhaps operating at one scale and considering growth generally. I don't hear many maple operators talking about giving up taps or getting smaller. So the prospect of growth, I think, brings with it the question of what's the investment, what's the next step to go to a different scale. So I hope tonight that some of that will be relevant. And then if you're actively managing a maple business, we get into the maple benchmarks, the financial analyses with active businesses. It's just great to see what's going on under the hood of these businesses, so to speak, see what the parameters are financially, and consider how it relates to your business. So here's some basic financial goals. Whether I'm doing kitchen table business consultation or we're doing research, these are the how questions. How much is enough? How much money is enough? How much money is needed? How much do you need at the bare minimum? And how much is possible? What's the scope of opportunity here? So let's think about that. How much is enough? How much is needed? And how much is possible in the context of some of these groups? Business establishment, startup investment. How much is enough to get started up with the right resources? How much is needed at bare minimum? Operating funds. It's not just the startup investment to get the tubing systems up and the tanks in place and the sugar house built. We've got to consider that first season, first several months even, labor, fuel, all the different expenses that are going to happen that aren't investments but are definitely necessary to get that business in production before even a drop of syrup gets sold, theoretically after the production season's over. Livelihood. What's your owner compensation? Are you looking for a paying job? How much is enough? How much is needed at minimum? How much is possible? Perhaps you want to give up some other work and focus more specifically on the maple enterprise. So we want to think about livelihood. Cost management for sure. We start to get into different cost categories, and tonight we'll look at a few of them, and we'll look at some of the frameworks. How much should you be spending or could you be spending on packaging compared to fuel, as an example? And then sales and revenue forecasting, a pretty important piece of the financial equation, is setting prices, having good sales targets, and being able to not only plan for and predict, but to achieve those revenue goals in order to have enough cash flow to do what you need for investments, operating costs, and theoretically back to livelihood, getting yourself a paycheck. I'll start off with some startup investment research we did. We worked with Rob Gay at Viewpoint Ag Valuation and Consulting over the past year. I think it's important to note that some of these resources could be a little dated with the recent inflation over the past several months. So if anything, these cost estimates, I hate to say it, could be a little bit lower given that a lot of things have gone up in the past year. So Rob went out and he basically spec'd out different maple operations at different scales, worked with two different equipment manufacturers and their dealers, and looked at what would it cost for a bare minimum to set up a business. We've got two different profiles. I'll show you. We've got sap collection only without processing the sap into syrup, just the sap collection. And then the other profiles are going to be sap to syrup, where we're actually going to bring that sap from the woods into the sugar house and finish it into syrup. The sap to syrup processing models are all based on putting the syrup into bulk barrels. We're not looking at any container type packaging for retail or anything of that nature. It's considered a bulk business for simplicity on the investment. I'm going to reach over. I've got some printed copies of the profiles. There's a lot of assumptions that I'll glaze over a little bit tonight, but I want to refer you all to these profiles that are online. And we got several scales and different growth stages. Okay, so first looking at the SAP only profiles. Again, this is a basic financial model where Rob and I went and we said, what are the basics to set up an enterprise? Let's get those basics down. Let's figure out the general cost and get it documented for a startup investment. So we've got tubing system and setup, monitoring systems for leak checking, vacuum pump or pumps. We got a little bit of power driveway, some basic site work. We've got the extractors, releasers. We've got tanks. And Rob set these up pretty lean and mean. So the SAP onlys have a shipping container, which should be a home site in the woods to house the equipment. We looked at a bunch of different scales, 3,000 taps up to 15,000 taps. I'm going to show you a lot of numbers in a second, so I'd just ask you to think about what you're most interested in from a scaling perspective. You'll see similarities across these different scales. It's a pretty coarse investment model we used, but rather than get overwhelmed with 5 different business models, be thinking about what scale you're most interested in. So here are 3 of those scales, 3,000 taps, 5,000 taps, and 7,000 taps. You can see that across the top. And then we've got 2 rows here in this table. We've got the startup investment for the SAP enterprise without the purchase of the real estate. So this is going to be the investments I just mentioned. And then we've done a little bit of an add-on. That bottom row is the total investment plus the cost of forest real estate, assuming it's a purchase. And for this line, we used a basic metric of $2,000 per acre. Some of you are going to be in regions where the values could be lower, $500,000, $800,000 an acre for forest land in pretty rural places. I also know that folks in Western New York and Pennsylvania are looking at expansions, and because of the real estate costs there, they could be looking at well over $2,000 an acre. So these are really basic course estimates that at least get you, on the planet, so to speak, and then you can fine tune from there. And I've got 2 more samples here. I've got the 10,000 tap and the 15,000 tap model. Again, same rows. We've got the no forest investment, just the equipment, and then we've got the forest estimate below. I'm going to circle the things that I think are most important. The dollar values across the scales obviously change because there's more taps out there. But if you look at that top table, the 3,000 taps, 5,000 taps, and 7,000 taps, you're going to see that we feel like the SAP only setup in a very modest system is going to be running in that range of $34 a tap down to $31 a tap. That's a number. It's a number that you can take. I wouldn't say you could take it to the bank just like that. You build it out and work from it. But these are the magnitudes we're looking at for these SAP only setups. Obviously, when we start to add in the cost of real estate, these numbers are going to go up. And if I click, let me see. No, it's going to go away. So when you start with that $34, $32, $31, the top table, $31 for the 10,000 taps, and the 15,000 taps, I'm going to check if that's a typo, 37. I know that some of our systems haven't gotten cheaper with scale, but for some reason, I think that is going to be a typo. I'm not going to be able to check that now. So I'll ask you to make a note. If you're looking at that 15,000 tap, double check that 37. All these guides are now posted online, and we'll cross-reference that. So you can look at those numbers. $30 a tap. If you add the real estate on, we're certainly bumping it up. $2,000 per acre. It's, adding almost another $35, $36 an acre. Or a tap, I'm sorry, $35, $36 per tap additional. So now you're up to $70 per tap, $68 per tap. Significant investments for sure. Definitely a more modest investment here with a SAP only enterprise than if we're going to go into syrup processing, which I'll do in a second. I'll leave that up for a minute so you can take a look, find your numbers you're interested in. Okay, now we're going to go on to SAP and processing combined. Generally, I think whether it's nostalgia or mindset, perhaps control, people certainly love the idea of harvesting sap and making a finished syrup product. So we're going to start to add, we're going to start with the investments we had before, everything from sap collection. Then we're going to add some basics, a sugar house, reverse osmosis, concentrate tank, additional tanks, permeate tanks, evaporator, filter press, miscellaneous tools, barrels. Again, lean and mean. I think it's important to note that this investment profile generally will show a lower investment level than the benchmarking project I'll show later in the presentation. With the benchmarking work, we're going out and we're meeting with actual business owners, and we're stacking up all the things that they own, everything in their sugar house, everything in their business office, everything in their garage. And there's a lot more things included in an active business. We've got laptop computers, we've got specialized equipment that didn't necessarily make it into this model. Some people have tongue equipment to pull logs out of the woods. All that stuff that we would expect is relevant and I don't want to say necessary, but not a surprise given a specific site or a particular type of management. These models are going to be, I'd say, as lean as you get. So I'm going to pop up tables again with a lot of numbers. We're going to see 5,000 taps, 10,000 taps, 2 models with direct the sugar house systems. Then we're going to also look at some hybrid models here, which we think is very relevant for operators. 10,000 taps is going to be 7,000 taps directly to the sugar house, plus a 3,000 tap woods that's adjacent for sap hauling, not necessarily owned. We've got the 20,000 tap model, which is the assumption of a 15,000 tap enterprise going directly to the sugar house, and that same operator going and finding a lease for 5,000 taps nearby and hauling the sap back to the processing facility. We've got a circle there, but we got no numbers. Let's open it up here. I'm going to go through a couple slides with the 2 different models here that are direct, and then in a second I'll flip over to the hybrids. I circled that per tap number again. You can certainly see the magnitudes. 5,000 tap direct over $250,000 before the forest real estate. 10,000 tap direct, almost $500,000 before we buy the real estate. Those numbers certainly are going to flex depending on what you're considering yourself. So I think it's always great to look at that per tap metric. 5,000 tap direct, we got $52 per tap investment. 10,000 tap direct, we've got $45 per tap. What I've noticed with this project is that the economies of scale seem to stack up a little bit better once you're into processing. And I'm going to check that typo again on the largest SAP only enterprise, because I think that 37 was off. But what we'll see is that there is some cost savings as SAP only enterprises get larger. But I think the numbers have shown that the economies of scales kick in a little bit more with that processing facility. Now, I don't want to tell you that in order to save $7 per tap, you've got to spend $400,000 more making syrup in a processing facility. But if you're thinking on a per tap basis and you're thinking as I start to add units of production here, it looks like processing does start to experience some economies of scale. So I know that's kind of a misnomer at the bottom, that processing gets cheaper as the scale increases, because I think everyone would agree that processing is quite an expensive endeavor to get set up for. So here's our direct models, $52 per tap, $45 per tap. And yeah, I mean, we start adding real estate in that 10,000 tap direct model and over $800,000 at minimum. These are significant capital investments. Now we've got the next 2 models, which incorporate a direct-to-sugar house setup. And then there is this 3,000 tap satellite bush. The larger 20,000 tap operation has got the $5,000 satellite bush. Looking at those numbers again, you'll still see that cost reduction on a per tap basis. Again, the processing facility savings starts to kick in, and we see $46 per tap with that 10,000 tap model and $40 per tap. This is our lowest so far with the 20,000 tap model. Of course, when you look at the total cost there, fully loaded with real estate, we're looking at over $1.3 million. So again, I don't want to keep harping on saying that it's cheaper to process at a large scale. It's certainly a significant capital investment. These are fairly basic numbers. These are great guidelines, I think, for people, especially someone that's at 2,000 taps, maybe thinking about 7 or 10,000 taps. It's very likely that a large amount of your system would be completely overhauled, possibly liquidated in order to set up your new system. So being able to peg the number, whether it's $30, $35 per tap for a SAP setup, or we could be 45 to 50 for a processing setup, at least gives you the sense of how much capital you're going to be investing in this business to get going. Okay, so shifting gears now, that got us through our startup investment models. Looking at cost analysis, this is going to be a mix of some of the benchmarking work that we've done and hopefully getting you to think a little bit about your own business. Cost analysis first or last. As a business planner, boy, it's really tempting to count revenue. I think as a business owner, I think everyone loves to do sales forecasts. As a discipline, it's great to consider doing cost analysis first. If you can do the cost analysis, you can start to line other aspects of your business up with the cost structure. So what does cost analysis improve? Certainly cost management, right? We're going to look at specific line items. We're going to think about how we can better manage the costs. Setting sales goals. If you have a sense of your cost structure, you can then be a little more thorough, more accurate in setting sales goals that certainly cover your costs and cover your cost theoretically plus profit plus margin for your owner and management. So knowing your costs really becomes the key to having a good marketing plan, having a sales forecast. And I mentioned setting prices as well, not just total revenue, but setting the specific prices. If you're in a position to do that, certainly is it's part of the equation, and knowing your cost is going to be the first part of that. With any enterprise, whether I'm talking to a manager or I'm looking at the financial statements, I try to identify the top 3 costs. There's a lot of costs on a financial statement. I don't think it necessarily is worth the effort to go chasing certain cost categories that are minor. I certainly would look for the largest ones first, and then the second question is to ask which of the ones that are possible to manage. An example of a fixed cost, like maybe an insurance policy, yeah, you could shop it around, but will you be able to have any major cost reduction on insurance? You have to ask yourself that. You have to know the system and try it. That's very different than looking at a cost like, let's say, packaging and trying to figure out, do you have the option to make any improvements on how much you spend there or not? So those are going to be really specific questions per business. What are your top 3 costs? And then of those largest costs, I would try to highlight the ones where you feel like you have an opportunity to make a change, make a management decision that could impact that. Looking at these categories here, this is what we found in our benchmarking work. This is somewhat of an aggregate over the past few years. The percentages will change a little bit, but what we found by and large is the largest 2 cost factors for most businesses: labor, a combination of paid labor and the unpaid labor, the value of unpaid owner labor. Next largest cost is depreciation. The sleeper here is both of these are potentially non-cash expenses. The paid labor is certainly a cash expense, but unpaid owner labor, not necessarily a cash expense. Definitely operators out there running business entities, they'll keep what's left over if they can. If there's nothing left over, that's just, it gets rolled back into the business for investments or operating costs, and that's the nature of running a small business on good years and bad years. So there could be a lot of non-cash expense there with unpaid, and then depreciation, definitely a non-cash expense. You've already had your investment outlay on the equipment, but the depreciation is the wear and tear and the loss of value on that equipment over time. It's not a cash cost that you write a check for. Theoretically, you could put that money away in a side account so that when the RO times out and it hits its lifespan, you actually have that money available for the reinvestment. But it is not necessarily a check that you write. It's an economic calculation. It's an accurate calculation, we feel, to evaluate profitability. But I certainly get beat up when I work with people and they say, you know, Mark, you give me all these costs that don't actually exist. And I say, I know they don't exist, but depreciation can catch up with you. And believe me, unpaid owner labor, I hate to say it, but it's starting to catch up to owner managers that are looking at maybe business sales, exits, or transfers. It's one thing to want to run your business for the passion and maybe sacrifice some compensation. It's a whole nother thing to try to transfer that business entity to another person and expect them to make that same compromise on compensation. So we want people to factor that cost in and try to find a business model that can start to chip away at it. So labor, depreciation, and we've got a whole bunch of other categories, and it really will depend on your business model there. Packaging and supplies. I don't say supplies. Supplies is a general. You all know that from your accounting. Supplies is your biggest expense category because it's all dumped in. But packaging specifically can be extremely high with retail-focused businesses. So I'd say paid labor, depreciation, and then once we get past those, we really get into this business-specific analysis to figure out what's number 3, what's number 4. So what do we do though? These aren't numbers that necessarily tell us that we're going to shop for a better evaporator. These aren't numbers that are telling us specifically if we can maybe use some different components in our tubing system to save money. These numbers tell us that we need to focus on labor efficiency. If theoretically we're paying ourselves or we're worth something to pay and we're paying other employees, we want to focus our cost management on keeping labor as efficient as possible, and then making appropriate investments in maintaining property. If we can maintain our equipment longer, if we can tune it, service it, take care of it, avoid accidents, then we could be having potentially the biggest impact on our maple business, because these are the biggest pieces of the pie. So when I talk to managers about this idea of being effective as labor managers, managing our labor time, I hear people basically saying, you know, what we need to focus on is paid labor and, let's say, unpaid owner labor. Every effort should be made to making sure that extra labor or the focus of labor is placed on yield and revenue enhancing activity. I know that's a big generalization to say that you're always going to be finding a way to make money, because there is stewardship of the forest. There's plenty of activities off season that don't seem like they're directly related to harvesting the sap. But for those that can, and when the time is right, to be very specific about when you deploy time, make sure that it's doing something to enhance the yield of the sap and or the overall revenue of the business, because that's what's going to be able to compensate for your time. Some strategies: setting targets on time spent rather than just having it be until it's done, but setting targets on how much time is available, setting targets on criteria for improvements, projects in the woods. And then as far as employee management, boy, there's a whole world out there on building strong teams, strong communication, giving employees the incentive to perform within your business. And I would highly encourage you to, when you get a chance, to grab some leadership books, grab some resources that really can help you form your team, because there is opportunity to compensate, there's opportunity to create incentive, and certainly celebrating performance with employees are great strategies to keep them invested in, and not just the hour of work and the wage, but the overall success of the business. Some of the big ticket items: tapping training, making sure that the people that are tapping your trees are skilled, they've been trained, you've got the right equipment. Leaks from the tap hole inappropriate tapping is often cited as one of the things that can really wreck the yield and can really hurt a business. Leak checking in general in season, if you're on high vacuum systems, spending the time, again, putting that paid labor out there to keep the leak check going and to keep the system tight is a yield and revenue enhancing activity. And then the mistakes, we do hear this, different mistakes, valves, cutoffs, hookups, making sure you can avoid those spills or those overflows. That's giving away the money that we all need to make these businesses viable. Yield investments here, just a couple examples. Theoretically, spreading fixed cost over more units. Again, that's the scaling thing, which I know is difficult for some people given their constraints, but we do see some efficiency as the scale gets a little bit larger. And then yield enhancing investments again. So not just the labor to increase yield, but what are the things you can spend money on to enhance your yield? Maybe it's a forestry practice, maybe it's that tapping equipment, the things like that. Scales, another thing comes up, scales and measurement devices, a way for people to really fine tune what's going on, whether it's production or whether it's retail based. A few more here, tubing upgrades, not putting them off if you can, making sure pumps are functioning. Certainly hear about aging pumps not drawing like they were. Remote sensors and leak checking, I think, is something I've certainly come to realize for some people is a way to enhance yield. Sometimes leak checking comes with a trade-off of more labor, more time, possibly more payment going out for employees that have to check leaks. So there is a trade-off there, but generally I think people have been finding that they can get their yield levels up across the board, right? How do we increase yield and then yield and price? All those things factored into the costs. I'm a little light on marketing. I'm a finance guy, so I do leave it to the creativity of you all to figure out what investments can be made to increase the value of your final product. It's one thing to be chasing more sap in the woods. For some people, they've already hit their maximum, already at 27 inches vacuum, pulling as much as they can out of strong, healthy trees. That's going to give you the sap to make as much sugar as possible. But then what happens once you've got that syrup finished? Is it going into bulk barrels? Is that the best fit for you? I know for some people, getting rid of that syrup before they have to market it is the cleanest and the most efficient use of their time because they're going to move on to other activities over the rest of the year. For others that have more of a marketing bent, what are the investments you can make to increase value? Not just to increase costs, to add cost to retail, but increase that value of syrup. All right, we're going to flip gears here now to benchmarking. There's a look. The 2020 Northeast Benchmark Report is on our website. And if I didn't mention it, those startup guides that I showed the numbers for earlier, each of those, I think there's 6 or 8 of them total. Those are posted on www.maplemanager.org. So you can see those startup guides as well. Let's look at some of the numbers here from our 2020 analysis. Sticking with the theme of startup cost, I thought I'd start with intermediate investments in intermediate assets here. Average investment over the, I think, 12 to 14 businesses we worked with in 2020, about $47 per tap total investment. That's the average across all of them. I will say I don't know if I've got the sample here. In 2020, we've definitely shifted gears from prior benchmarking years. I think our smallest participating business is around 7,000 or 8,000 taps in 2020, and we're up to a couple businesses over 50,000 taps. So we are moving to much larger scales when you look at this benchmark project. If you looked at some of the reports from 2014, 2015, 16, we had some smaller enterprises here, and some of the investment numbers could be a lot larger. So $47 a tap average. We've done some different breakouts here, and we'll find that the above average yield producers in this study are looking at $56 per tap. Definitely higher than the $47 average. And then we look at the below average yield producers in this same group here. We've got an average of $39 a tap. And this is something we've seen consistently for the past few years here, that the larger yielding operations tend to have newer systems, higher value systems, higher startup investment, or more recent investment to achieve that yield. So the high yield is certainly possible, high investment in order to accomplish it. On the bottom right, that chart shows you the different average investment level per tap at scales. And this one, I look at this, having worked with a couple of these producers directly and seen the numbers on the other ones. I'm not exactly sure why we've got a spike $68 per tap for the 8,500 to 15 or 14,999. With any of these projects, the small cohort studies we've got, I like the idea of breaking it into two groups there, the above average yield and the below average yield. Once we start breaking it into these small groups, we could potentially have maybe only 3 or 4 people in one of those groups. So I'm not ready to say that 8,500 to 14,000 is going to be a huge additional investment. It could be, but I'm not exactly sure if the numbers are biased because of the small sample. Going through the producers that I know are in this group, one thing that I will say is I have a feeling that we've got a couple more businesses in this scale that are heavy into retail and wholesaling, which adds another level of equipment to their setup. Potentially delivery vans, delivery vehicles as well are costed out in these models. So that could be what's going on with that 8,500 to 14,999. It could be the additional investments for packaging, retail, delivery. I do know that the larger enterprises over 15,000 almost exclusively, well, not always bulk. Most of them are bulk, but there's a couple people doing retail in that group of $41 per tap. So I'm just talking through the nuance here, small benchmark study here. We do want to be cautious. We want the numbers to get us to think, but we don't want to make some conclusion that could be misguided. Now we're going to look at cost of production. Right here, I'm just going to look at the bulk group. Cost of production on the retail and retail wholesale mix can be confusing with a small benchmark study. So I've got some estimates I'll show you in the next slide, but the bulk one, we do think it's worth looking at these and trying to figure out if there's a trend. When I look at the pounds per pound I've got circled there, average in 2020, 241 a pound. Feels like the right average you're looking for. The low 162, certainly a low cost of production there, and the high 307. I'm not going to jump ahead and say that the 60, 80,000 tap enterprises in the study are necessarily all the 162 or $1.80 per pound cost of production. Some of the newer enterprises certainly are running higher cost. It's not just a function of scale. I think it'd be dangerous to assume that just because you get big, you can drop your cost of production below $2 per pound. I think it's possible, but I don't think it's a guarantee. We also do have the potential of having some older businesses with some really worn down equipment that often get us to a lower cost of production, like 162 if the sugar house has been fully depreciated out. So some of this is also going to be age of the business. Anyway, 241, this is consistent over the past few years. We've definitely seen these spreads of low cost and higher cost bulk producers, but we've often found this average is somewhere around 230, 240 a pound cost of production. So looking at that retail wholesale mix, these are numbers that really don't exist anywhere other than an average on paper. We do see this average of $4 a pound or around $44 per gallon equivalent for some of these businesses that mix retail and wholesale. The reason I say the average doesn't really show up anywhere on paper, we've got large differences with someone who maybe they're selling 70% of their syrup bulk and 30% is going to a very high value retail direct marketing. In another situation, we could have someone with 60% or 50% of their syrup being sold as bulk, and the rest of their syrup maybe going to some mid-value retail, but maybe some more wholesale accounts. So that price, the $44 a gallon, probably doesn't specifically show up across the board. It may for a particular package size, but it's kind of an aggregate of the whole business. But again, going from $2.40 a pound cost of production to this $4 a pound, we're almost not quite twice as much on cost of production to have these mixed models. Now, going to the next level, the heavy retail mix, we have worked with a few enterprises, anywhere from 2,000 to 8,000 taps that are doing heavy retail. And what we find by and large is their per gallon equivalent cost of production anywhere from $75 to $90 per gallon. What does that tell us? This tells us that anyone that's running a large amount or majority of retail sales probably is not in a great position to be selling syrup strictly by the gallon or a half gallon. You do need to be finding retail price points for package sizes that are going to be up to $75 or $90 per gallon equivalent. So I can't spec you the prices right off my memory here, but that means we've got to find the comparable price for quarts, pints, and half pints that will get us into that $80 range per gallon equivalent. Again, we're not selling gallons here for $75 or $90 per gallon. The per gallon equivalent means when we take our whole crop and we spread it, everything from nips to a small number of gallons, we're going to get that $75 to $90 range. Net returns. So we've seen investment, we've seen cost of production. Now we got to look at what's left. This is what we found in 2020. I got two groups there on the left. I've got a less than 15,000 tap group and a 15,000 tap and larger group. Those are the rows on the left-hand side. And then I've got some ranges. We've got a low, a high, and an average that we'll look at tonight. This is what we saw in 2020. We've got the less than 15,000 tap group. We had a negative 12% margin, negative 12% profitability, range high up to 9% and an average of 2.2% positive profits. The larger operations, again, a small group here. We've got several people over 15,000 taps. We've got a range of negative 10% to positive 9%. The overall average negative 1.6%. What does this tell us? I don't know if this tells us so much that larger enterprises are less profitable. Again, with a small group, I'm not going to jump to that conclusion. What I would say is equal opportunity for profit, equal opportunity for losses here across the industry, site-specific, management-specific situations. No guarantee, no silver bullets here. Getting bigger clearly doesn't necessarily put you in the profit zone. And I think some of the things we mentioned earlier, there's investments, there's costs, there's labor, and there's sales plans. And all those things have to come together in the right way to drive a maple business into profitability. Down at the bottom, I do have the bulk profit margin. We had negative 1% and the retail 1%, very close numbers here, really right on the fringe there on 2020. I think there's some people that did well, some people not so well. I'm going to make a note here. In 2020, people were pulling in revenue from the recovery programs, the CFAP program. And for this study, we actually withdrew government-related income. It's not syrup-related income. So anything that wasn't directly related to syrup sales, we did pull out of the equation. So in some cases, these businesses may have cash flowed just fine because they got a check from the government, but the syrup business on their own didn't necessarily cut it. Okay, some takeaways from the benchmark here. Marketing strategies are a significant driver of the variable costs. We've got a few businesses that certainly look at retail wholesale blends. They're doing different sales activity. These sales activities add labor, they add costs first and foremost. I know that the literature, the agricultural literature specifically often talks about adding value, which is terrific. I think it's important as a cost manager to realize these activities add costs first. It requires labor and time to execute a direct online or wholesale retail marketing strategy. Those costs get incurred, and then we've got to find a way to price, and we've got to find a way to move enough product to make good on those. We certainly see that. High labor costs with intense marketing strategies. Yield strategies, high yield producers, like we showed earlier here. We can produce a lot of syrup per tap. It will drive investments up. It will drive investments up. And I think this is a classic for business managers, humans in general. Some people, whether they've got capital equity to invest or they're really less concerned on risk, the idea of debt, the idea of borrowing. Some people are investors. Other people are doers, they're workers, and they'd rather put time in, they'd rather have their hands on things. Certainly marketing is its own skill set, but I see some divergence there. I do see some people that are definitely more investment minded, investment driven, and other people that are a little bit more operational and saying, I want to put my time into this, or I just don't have the $500,000 to invest in that scale. So they're going to run a business differently. A couple more takeaways. Profitability we looked at just at the end there. Profitability is not always directly related to low production costs or scale of the operation. There's a real connection across the whole system, which is going to be costs and revenue and how they integrate. So just having a low cost of production or just being at a large scale does not necessarily make you profitable at all. So from a management perspective, what do you got to do? You've really got to go back to that cost analysis we talked about earlier. Got to find a way to understand your costs, understand your model. Is it an investment model? Is it a heavy labor model? Understand that cost structure, and then pair the ideal revenue generation with that, the ideal price setting, the ideal marketing plan and sales forecast to bring in the revenue you need, pay down that cost of production, and then ideally have some margin left. Okay, cost versus revenue. A couple things related to sales plans, because sales are important. Sales are important to finances. These are some things I've seen with the bulk producers. We've already talked about emphasis on yield per tap, right? We don't want to leave any sugar in the woods. We want to get it out, get it through our lines, and get it converted into sap. We've got bulk producers that are definitely looking at the option to purchase sap. You've heard me say this over and over again. The idea of bringing in some extra sap, running it through your system can certainly spread some more of those fixed costs over more units produced. So the idea of bringing in sap to increase sales, great strategy. And then always there are people with creative solutions to move just a small fraction of their crop at higher prices. First off, well, let me just say certified organic premiums. Yes, plus 10, plus 20 cents per pound. A great strategy. That's going to reprice your whole crop. So that's the whole thing. But that idea of just finding a restaurant, finding a low intensity outlet where you can move some syrup retail can be a dramatic shift for even a large business. The key with all of that, anytime you bring on marketing, the key there is to really be mindful of your costs. Figure out what the costs are going to be in order to figure out if that extra marketing effort is worth it. Yeah, good question. So Andy asked, would you say that below 3,000 tap syrup has shown not profitable? Quick answer, not necessarily. Would you say below 2,500 taps sap is not shown to be profitable? Not necessarily. The reason that we've really kind of steered away from that, couple reasons. I do think there's challenges. I do think that there are some significant challenges when you're at that scale. 1,000, 2,000, 3,000 taps, because you are going to be heavily invested, and generally at that point, the family and the volunteers sometimes become less interested, or they do trail out after a little while, and you're left with a lot to manage and maybe having to give up more of your paid time at another job, or possibly pay some people to help out. I have definitely seen 2,000 and 3,000 tap enterprises be profitable. Profitable in the sense that it's generally a part-time income, complementary enterprise to someone who's generating some money in other directions. The other reason we've steered away from the smaller enterprises is we found, in a good way, there's so much creativity and there's so much uniqueness at small scales. I don't necessarily see those models as being replicable from my job in the university. Part of the job that I feel is important is to find agricultural models that we can, I don't want to say train everyone on, but we can show that there's some patterns and there's some trends. And there's so much creativity at the small scale that I love to leave that to the entrepreneurial world. I'd love to leave that to for people to figure out what to do with that. You know, how can you get $150, $200 per gallon equivalent from syrup at a small scale. Can you turn that into a $50,000, $80,000 business? And I've seen people do it for sure. So I'm not trying to steer people away from those smaller scale models. But I will say that they're unique and I think they're often difficult to, I'd say, quote, like replicate. So great question. Definitely a great question. I think you can run those as a viable part-time enterprise. One of the reasons we have gone to larger business models for this, the benchmarking research particularly, is from a rural development perspective, we know that there are a lot of people looking for meaningful livelihood, meaning more than like a very fractional part-time job. Being in rural communities, not everyone's got opportunities for other employment. So we are trying to get a better sense of those business models that could return maybe $30,000 a year back to the owner manager or more. So that's another reason where you'll see a lot of the projects I'm on gearing towards some of the larger TAP enterprises. Oh, so we mentioned the bulk strategies. This is the strategy that we've been advocating for people that are doing retail or wholesale. We've got this pricing and sales forecasting calculator. I've had a lot of fun teaching classes with this with people. I'll wait now and see who's on the line, but I can certainly go on and do an example if people want. But in this calculator, you can go and basically put a theoretical crop value in, and you can determine if you want to do bulk sales only, if you want to do bulk sales and retail and wholesale, or just retail and wholesale. So getting away from the cost side here, now we're getting the sales side, being able to itemize how many packages at what price you want to sell. It's been great in our classes. We set challenges up and said to people, show us how you can get to $110 per gallon equivalent, or here's a cost structure where if you can get to $80 per gallon equivalent across your crop, you're gonna cover your cost and break even. So I highly recommend it. If anyone watching the video or watching live tonight is doing retail, go to www.maplemanager.org, put in your crop and start to deal it out. Half pints at a certain price, quarts at a certain price. I think we've got like over 15 package sizes built into the calculator. You can set the package size, set the price, and look at a total sales forecast. Top right there, you're going to go to unit 1, pick your pint, set your price, specify how many gallons you're going to sell. Unit 2, and you can keep adding more and more units there until you utilize that whole crop. Get yourself a good high blended price. Then ask yourself, how am I going to develop the marketing plan to execute all those sales? That's what I've got tonight, I think. Yep. Couple photos there. Chris Lindgren there, top left. He'll be doing a SAP presentation, SAP business presentation next week. I'm going to open it up. Great. Well, if we've got no questions, certainly thanks to those that came live tonight. Hopefully we'll have some people watching the video. Have a great evening. Keep an eye out. We've got a couple more UVM extension projects coming up, webinar next week, and then we're going to be into conference season. So some of you may see UVM extension specialists in Ohio or out in Wisconsin, and potentially, or obviously, the Vermont conference is coming up. All right, thanks a lot, everyone. Have a good evening.